Greetings and welcome to our webinar series, Coronavirus and its Impact on People, Process, and Profits. My name is Yenma Herb and I will begin today's call by covering a few housekeeping items with you. This webinar is being recorded. The recording of this webinar will be provided to you in the follow-up email. Materials for this webinar were emailed to all registrants around 10 a.m. this morning. You can also find the materials on our Coronavirus Resource Center at rklcpa.com. All lines are muted and will stay muted throughout the webinar. Should you have questions, they can be submitted using the Q&A feature at the bottom of your screen. However, due to the size of the group today with more than 900 registrants, we will only have time to address a few questions throughout the webinar. RKL clients who have questions specific to their organizations should reach out directly to their RKL advisor. Lastly, 1 hour of CPE in the field of business law will be issued to participants on this call. To receive your CPE, participants must be connected to the session, both audio and presentation, for its entirety. Additionally, participants must answer 3 questions and elements of engagement. In this case, elements of engagement will be through the polling feature. A couple items to note about the polling feature. If you're viewing through a web browser, ensure that you have pop-ups enabled. Also, if you're using multiple monitors, the poll may appear on your second screen. So now that we've covered all of the housekeeping items, I'm going to turn it over to Ryan Hurst, who will introduce our team for today's webinar. So over to you, Ryan.
Thanks, Emma. Good morning, everybody. It's good to be back this week after a week off last week. Joining me today for the first time, 2 folks that you haven't heard from before will be Barry Pelagatti. Barry is a partner in our firm, part of our audit services group, and leads the firm's financial services industry group. He's going to be speaking with you today about US GAAP accounting for PPP loan forgiveness. Bob Pozesky is also joining us. Bob is a practice leader of RKL's operations consulting practice. He deals with lean manufacturing, process improvement, and those sorts of items, as well as leading our manufacturing and distribution industry group. And Bob is going to be speaking today about workplace reopening and safety best practices. And I will kick things off with an update of the Pennsylvania reopening process, talk to you a little bit about the Phase 4 stimulus that's been proposed, and then go into our PPP loan program updates. Okay. Sorry, I got a little delay here on my end. So in a moment, the Pennsylvania state map should be coming up. There we go. So this is a map that anybody who's been on the webinar with us the last couple of weeks has seen before. This is our 3rd time showing it. This map is basically looking at the 50 new cases per 100,000 tests throughout the state of Pennsylvania. That is one of a few criteria that are going into the governor's mandate or the governor's reopening criteria, shifting from red to yellow. Some other factors there are the availability of PPE, health system capacity, testing, contact tracing, those sorts of things. So as of now, 13 counties are being added to the yellow group today. You can see those in sort of the lower left-hand corner, southwestern corner of the state. There's those that were already moved to yellow last week. They're in sort of a beige color at the top, including those that are behind that line chart. The only county in Pennsylvania or in western Pennsylvania that is not in yellow yet is the blue one on the left side of the screen. You can see it below your chart. That's Beaver County. We'll talk a little bit about that one in a moment. Additionally, there's supposed to be an announcement forthcoming today from Governor Wolf as far as additional counties that will be shifting into the yellow at some point. So far, it's been an announcement one Friday, and then the next Friday, those counties that have been released ultimately can reopen. We don't know for sure whether that is going to be the case or whether there's going to be a little bit more of a lag this time between announcement and officially being permitted to reopen at the state level. As far as the data on this chart, fortunately, most continue to trend down week over week. If you remember last week, only one county had increased a little bit. That was Lackawanna. This week, week over week, all counties have trended down except for slight upticks in Berks County, Dauphin County, and Northumberland. Of note, though, Northumberland is in the official yellow group and has remained so despite its small uptick in this metric. Some other news as it relates to this data, I'm sure many, if not all of you have heard about as it relates to Pennsylvania. Several counties had pushed back earlier this week and said that they would shift themselves to yellow as of today. Many of you, I'm sure, saw that the governor pushed back midweek with several threats to reallocate funding, pull insurance coverage, impose citations, and strip offending businesses of licenses. Ultimately, that led to several counties backing down, specifically York, Berks, Dauphin, Cumberland, Franklin, Adams, Perry, and Schuylkill. They were all originally on the list of folks that were saying, we're going to circumvent the state's orders, and then they ended up backing down. They are continuing to push for modifications of the administration's plans, but they no longer have kind of the plan to take things into their own hands. As of yesterday, Lancaster County, the commissioners asserted that they will be moving to yellow today, but no formal action has been taken, at least at this point. So there's not a really clear message for those of you in Lancaster County, even at the county level, where exactly Lancaster stands. Lebanon County appears to be heading towards its self-authorized reopening. That one seems to have a little bit more clarity that Lebanon is looking to shift itself into yellow with an official decision being made today. Beaver County, the blue state all the way on the western side of Pennsylvania that I mentioned a little bit ago, that is another one of those circumstances where they're a little bit up in the air. There was some talk about that county kind of moving itself into yellow next week, although the rumors are that Beaver County would be on the group of counties that would actually be permitted by the state to reopen today. So I think they're retrenching a little bit and not wanting to rock the boat. Like I said earlier, Governor Wolf is expected to announce that more counties today will potentially shift to yellow. That may occur next Friday, may occur on some other date. We'll have to see when that announcement actually hits. Last week it hit right around noon or so, so hopefully we'll have that early afternoon today again. And the last thing I just wanted to do with this slide is just to clarify this June 4th date that's out there. Many folks have been looking at that June 4th date and saying, well, that's the date we can officially move to yellow, and that's too long or too soon or whatever the case may be. But here's the deal. I think some counties are going to be moving to yellow ahead of that date. And I think there's a decent chance that some counties may even be pushed back after that date, depending how they trend. So I don't necessarily look at that June 4th date as the official date. It's moved before at least twice, and it certainly hasn't stopped new counties from being shifted to yellow already to date. The second slide here then is some data I wanted to share with you that we saw from an employment survey that was conducted by the Washington Post Ipsos Coronavirus Employment Survey. This data ran through May 4th, so there's a little bit of a lag between the actual time frame that the data is covering as well as when it was actually published. So I think it's just important to know, whatever your position is, just at least what this survey is suggesting is that there is a pretty high approval rating amongst PA residents that were surveyed on the way that the state is handling things. So that certainly is a practical consideration as you with your businesses decide ultimately what you want to do, especially if you're in one of those counties where it's maybe not, where a county is maybe looking to go against what the state's at least recommendations or orders are. We'll bring up our first polling question at this point. Just a reminder, to be eligible for CPE credit, 3 polling questions must be answered. And our first polling question is that, which guidelines will you follow for reopening? I'll follow my state. If my county comes up with its own plan, I'll follow that. My business is life-sustaining, or I received a waiver, which means that you're already permitted to operate if you want. Or you're already a yellow county or not located in Pennsylvania. We'll leave this poll open for 2 to 3 more minutes. Remember, if you're looking for CPE credit, you definitely want to select one of these items. So we'll move in just for a moment into the Phase 4 stimulus. Many of you probably saw earlier this week, the House introduced a $3 trillion HEROES Act. It's got a mix of items in it, including state and local government relief, an extension of unemployment provisions, including that $600 bonus that we're all familiar with, some hazard pay components. This bill really focuses on the employee retention tax credits as far as its business stimulus. There's no additional PPP funding in it. But there are some PPP modifications that we'll talk about in a moment. Also have some provisions on family relief and some pretty important tax elements that we talked about a couple weeks ago. Some potential repeals of some of those elements. It's important to keep in mind that this is a bill. It is not a law. Anything that we're talking about on this slide and the next one, it's just really more an indication of what might come. The House is expected to vote on this today, but the consensus is that this is really a non-starter with Republicans in the Senate, and we're probably about 6 weeks out to really have this enacted into law at this point, once there's ultimately revisions that are made. A few PPP considerations that we took out of this, and again, these are not fact, these are just simply what's contained in the bill, which is not law, but there's some good indications. There's certainly support for that 8-week covered period for expenses to shift to 24 weeks, or at least some sort of longer period. 24 is just what's in the bill. Extending that June 30th end date to December 2020. So it helps with the rehiring of employees, and we'll talk a bit about that later. Another big ticket item is this 25%, no more than 25% of forgiveness going to non-payroll costs. So that's a big ticket item. It looks like they're looking to remove that element. You can kind of see some of the rest of them on this screen. I won't really dwell on them at this point, but you know, some elements in this that I think could be viewed by many business owners as pro with what they're looking to get out of this program. So now we'll shift into the actual PPP loan program update. Unlike what we just talked about, all of this is actually, you know, at least at the moment, it's what we know today, or at least an interpretation of something that's a little bit more official, as opposed to that bill, which is just a mere proposal and don't know what's going to go through. Some quick stats on this, about 2.6 million loans through May 8th in this second round, $189 billion that was funded through that date. I saw some data on the SBA's website today that it's at like 194 billion as of yesterday. So not a big uptick since the weekend. So I'm not sure if there's a disconnect in the data, or if it's just really slowed down in terms of volume with some of these smaller loans. A $73,000 average loan size, much less than the $200,000 plus loan size from the first round. Some updates on the PPP. We talked a couple weeks ago about the lack of tax deductibility. The update there is that there's certainly been some congressional pushback. Nothing official as it stands right now. I'd say the official guidance is that the forgiven expenses will not be deductible for tax purposes, but stay tuned on that. Some additional guidance issued on Wednesday that affects partnerships and seasonal loans. So if you're a partnership, that applied for the PPP loan and you did not include your partners in the loan amount in payroll for calculating loan amount, you can go back and add some more loan value on, subject to all the other limits on that program. Same thing for seasonal loan, seasonal companies that borrowed, making sure that they can maximize their loan based on the guidance that came out. A few other things, the electric cooperatives, if that impacts you, there was some guidance issued yesterday, and we'll talk about FAQ 46 and 47 in the moment. Still nothing new on loan forgiveness though, so just continue to be on the lookout on that. So FAQ 46 came out on Wednesday. This had to do with that whole May 14th date and the good faith certification. The kind of the highlights here, the big takeaways are, now they've clarified if you're under $2 million for your original loan amount, and it's very clear it's an original loan, so no ability to, we don't believe there's an ability to go back and repay a little bit of your loan to get you below that mark. But if you're under $2 million for your loan, you're pretty much all clear with respect to that economic uncertainty and the need for financing aspects of this. So you can kind of ignore that special documentation that we talked about in prior weeks. For those with a loan amount above $2 million, you're still kind of in the same place that you were before. Still highly recommend on that documentation that we've discussed. Still subject to the SBA review process. And one thing that did come out of this is very helpful is, one, there's individual circumstances is what will drive the the financial need test on that. But the good thing is that if a borrower ultimately does fail this certification and it repays the loan, there's no further enforcement. So it seems like they're taking some of the jail time and financial penalties off the table here, which was great to see, but you ultimately have to have the capacity to repay that loan if things go against you in the review process. FAQ 47 is really just an extension of this. It's the safe harbor deadline, which was yesterday, now pushed to May 18th. This is for if you decide to just repay the loan with no consequences. Not much difference in terms of repaying it now versus repaying it if the SBA kicks you out. However, the one difference that we're seeing that could be the case is with respect to going back and getting employee retention tax credits. There's no reference to employee retention tax credits with respect to FAQ 46, which is what we talked about a moment ago. But there is a reference with still being eligible for those tax credits if you turn in the loan by the safe harbor date, which is now May 18th. So maybe more to come there, but that's at least our interpretation of this guidance at this point. Also wanted to show you something interesting, leveraging Eric Wenger's example from last week. Gonna just give you the punchline, not gonna take you through all the numbers, but I just basically wanted to take this and take it one step further. For those of you on the line last week, if you remember, we had those two examples. The punchline was that the first one was the case where somebody said, well, I got the PPP loan and I'm only gonna hire those people that I need. I'm only gonna retain 20% of my workforce. Where the second one was the one that said, I'm going to go all in, I'm going to go 100%. I get it that I'm going to have a lot of people that I am paying to stay at home. And the way it turned out is that the second case was better off, certainly in terms of loan forgiveness, but also in terms of net out-of-pocket costs. So what we wanted to show you quickly this week is kind of taking that one step further. And that's that graphic on the left. You can see where we showed those two figures, the 831,000, which was kind of the amount that somebody was in the hole because they had significant FTE reduction haircut, versus the other party with the same circumstances that said, you know, I'm just going to retain 100%, and they got themselves back to zero. So what we did then is looked at that and said, well, let's bake in a couple extra factors, and we'll show a graphic on this. And we'll say, one, what really matters to you is, do you have any kind of other revenue coming in, or net other revenue, stuff that's outside of the PPP program that says, okay, well, maybe I can further offset some of this. And we said that's what we did with that orange line there. And we also said, well, what about somebody that maybe doesn't have quite the level of other overhead, so maybe not as much rent or utilities or mortgage interest, and said, what might that look like? And there's a couple observations here in these charts. One is you can kind of see this J-curve effect where, if you're at 0% retention, you tend to do better off, at least for a little bit, up till around that 50% mark. And then you start going back up the curve to get to 100% FTE retention. And, that's where you tend to be at the maximizing the loan forgiveness, as well as kind of maximizing your out-of-pocket. I mean, it's case specific, so I wouldn't get too caught up in all the details and all the specifics on here. But it's important to see that curve that we've tended to see a trend in some cases, as well as the potential here. If you look at this gap here between the orange line and the blue line around the 50% area, there are circumstances out there where you could actually be better off by actually not having done the PPP loan in the first place, and just said, look, I'm just going to hunker down as I always have, and I'm not going to worry about this loan. It's certainly something to make sure you're looking into as you figure out exactly how many employees you're looking to retain. With that, then, kind of an extension of it, I just want to quickly point out this June 30th deadline. There's been a lot of speculation about that, and just to bring a little bit of clarity in with that, two things. One, that June 30th deadline completely flips those J-curves we just looked at on their head. The great thing is if you can restore your workforce by June 30th to the February 15th level, then you basically take that FTE retention haircut off the table, and now all of a sudden you're looking at something a little bit more linear as opposed to that J shape. And, really it starts to look a lot better, and you have a much better outcome. It's also important to understand what exactly that June 30th restoration does and does not do. The key is that it removes the haircut. It does not get you to full forgiveness. So for instance, if you have a $250,000 loan, and then you ran the numbers originally and said, okay, I can get 225 of that, 225,000 of that is eligible expenses. But what I would normally do is, if I cut my workforce by 20%, I'd be down to $180,000 of forgiveness. But if you restore your people to that February 15th level, if you get the FTEs completely restored, you remove that 20% haircut and you're back up to $225,000 in eligible expenses. You do not, however, go to the full $250,000 loan. You'd still have that $25,000 of loan proceeds not forgiven. Last thing I want to show you, and then we'll flip it over, is just to address one question that we've been getting on a regular basis, and it has to do with this whole 7 weeks, 7 days per week, so 56-day period. And it really has to do with when does it start and when is the last day that I can incur eligible expenses. And as you can see here, so we assume that April 9th is the disbursement date, the date that the money hit the account. That's day one of the 56-day period. So we take that April 9th date, extend it out 56 days. You can see on the calendars that those are the green, and then we end up on June 3rd is our 56th day. So the 9th is day one, the 10th of April is day two, the 11th of April is day three, so on and so forth. Day 56 is June 3rd. And what you can see happens here is, in this case, we started on a Thursday and we finish up on a Wednesday. So I just wanted everybody to be very clear on that, so they're not thinking, not coming up with a magical 57th day or anything like that, and then missing out, especially as it might relate to actually making that final payroll if the incurred and paid test still stands. So I'm going to turn it over to Barry Pelagatti, and he's going to begin with a polling question.
Thank you, Ryan. Appreciate that. So we do have up on screen question number 2. Just as a reminder, anyone who's looking to receive CPE for this session, you will need to answer at least 3 of the polling questions during the actual webinar. So this question, are you comfortable with the current US GAAP accounting requirements? Yes, I'm a master of all things US GAAP. Maybe, but I'd like to discuss in more detail. No, I need help. Please have someone contact me. Or not applicable, I did not accept any PPP funds. So we will leave that up on screen for a moment or two. And while that sits on screen, I'll help level set where we are for today's session that I'm going to cover as it relates to the US GAAP accounting. So in prior weeks, we've talked about the various life cycle of the PPP program. We've talked about the application process. Last week, we talked in a lot of detail about the forgiveness model. What I'm going to do today is I'm going to shift from kind of the modeling to get to the receipt of funds and the potential amount forgiven to, okay, what is this going to look like on my actual records when I'm going through an audit of my financial statements or preparing internal documents to be discussed with my board and my management team. So again, the information is as of today. We are anticipating that the AICPA will be putting out some plain English accounting direction for everyone to be able to consume. And of course, we're always monitoring what the SBA itself is putting out on their website or with their FAQs that may potentially change any of the content that we walk through today. So a couple of kind of points to help all of you on the line understand the slides that are going to be forthcoming. The majority of you who are participating are receivers of these funds. So these slides are focused on individuals who are trying to figure out, okay, the money's come in, we have this cash, and while I don't like to talk always in terms of debits and credits, you're going to have this cash that gets recorded via debit on your books. And the question is, where do we put that credit? And then how does it ultimately flow through until the loan is hopefully forgiven to a large extent, and then subsequently we have interest expense, cost, and various other moving pieces. So if you're sitting on the line and you're a financial institution, which was a group that actually provided the application to the SBA and then funded the loans, this content will not be as applicable to you. And if you have any questions specific to how you would be recording that, we would be happy to answer that if you just submit a request through one of the polling questions. These slides are also not going to heavily focus on the accounting for the income taxes, as that is something that will be addressed by hopefully discussions with your tax professionals. But as Ryan alluded to a few moments ago in a prior slide, he did give somewhat of a sneak peek as to what the anticipated accounting is for the forgiveness of the loan and the related expenses. And lastly, before I advance the slides, if you're a public company who's listening in and you have questions about, well, how do we handle this from a SOX reporting perspective for our CFR, I would strongly encourage you to make sure that you treat this as a significant event, that you identify the controls around the application process, the forgiveness, the recording of the proceeds, and the full life cycle until it would ultimately clear your books, and to make sure you discuss that with your external auditors to make sure that you have the right controls in place to ensure that you would not identify any significant deficiencies or material weaknesses. So with respect to the slides in today's deck, the key accounting considerations that we are going to show are reflected on the screen in front of you. There are basically 4 components. The first would be, how should we as a company record or disclose what I'm referring to as the debt? I think most of you on day one, when you receive the proceeds, will find that the accounting literature points you to recording it as a debt or a liability until the ultimate forgiveness is calculated and can be recognized. So we will also address that. We will speak to, what about any costs you incurred to obtain the loan? Materiality is always a relevant concept when you're thinking about having to record entries into your books and records. So knowing that the SBA program for PPP did compensate the lenders through an agent fee, you may find that the cost that you incurred in obtaining or securing your loan, you may not feel that they're material. So the guidance that we're putting in the slides here is, if you are opting to reflect the cost as a cost of the funding, we're providing direction. And then also we've been receiving a fair amount of questions about, okay, once the funds are received, we have these eligible expenses. Hopefully a large amount of them are forgiven. We will also speak to how to record those on the income statement. As I mentioned a moment ago, currently there is no formal U.S. GAAP specifically speaking to the PPP program and accounting for the forgivable loan. So we are interpreting the prevailing codification to fit the facts and circumstances that we believe are most similar to a PPP program. We do also anticipate that the AICPA is going to be putting out some plain English guidance. And if we see anything come through there or from the SBA, I would strongly encourage you to talk to your engagement advisors to make sure that anything that may change as this continues to evolve, that you have the most current information available. So the accounting for the PPP funds themselves. So you receive the money, it gets wired into an account, you've got this cash. We are anticipating, and I will tell you from the research I've done and a lot of reading of literature, I'm anticipating, I would say that in my 20 plus years of accounting, most companies that I've worked with would probably fall under this approach A, as I'm referring to it, which means you would account for your PPP funding or that loan as a debt. So from a balance sheet perspective, and you will see references to codifications here if you'd like to go back and do your own reading or speak specifically to your engagement advisors with the codification in front of you. But for simplified purposes, when you receive the money on your balance sheet, that day one entry would most likely be a debit to cash and a credit to some sort of liability, whether you call it a borrowing, whether you call it financial liability, however you want to refer to it in your general ledger, you would be sitting there with a liability. And I've also provided some instruction from a cash flow statement perspective, if you're so inclined to want to read which category it may fall into. That's probably much more important to you if you are a public company and want to make sure you have appropriate classification from a SOX perspective. So this is what I'm referring to as approach A, which I do strongly believe will be where most of you will probably fall. However, I would be remiss in at least not informing you that we are seeing some organizations or third parties out there with all the information that's being consumed talking about an approach B. An approach B is something that if you're an organization listening today and you're like, hey, we receive government grants all the time and we don't typically account for them as debt. We have a different policy in place that we systematically utilize, and it's going through audit cycles in the past and we're comfortable with it. That's understandable. We don't want anyone on the line who potentially maybe is in a world such as potentially higher education where maybe you're seeing a lot of government grant type of accounting and you've taken the approach which is outlined on the next couple of slides. But basically what this approach B talks about is an approach where you know from day one that it's a grant and you treat it as income, and there's potentially opportunities for netting against expenses and just a lot of different interpretations from what we're seeing under the accounting for debt and the guidance provided by the FASB. So you'll see on these slides that we talk about referencing some international accounting standards that talk in terms that may kind of align with treating this government grant in a different way. And if this is something that's resonating with you, again, we're strongly encouraging that you understand that for a US-based company that follows US GAAP, IFRS standards are not considered the primary authoritative guidance. So you would want to get the advice of your experts before going down this route. But if this is an area that you've done in the past, we did want to provide some slides which talk about what the approach would be if you were to follow the IAS standard, some of the elections that you would have to make, the policies and procedures that you would have to have enforced prior to electing those policies. And again, I think it would just warrant a significant amount of additional scrutiny if you were to take this approach versus the approach A, which is just reflecting the initial proceeds as debt. And there's also different methodologies for the cash flow under the approach B. Now, whether you use approach A or approach B, I would not want you to lose sight of the fact that once you've recorded the journal entries, you are going to also have to record necessary disclosures. The global pandemic that we are going through is obviously a unique situation for most of us. And in addition to reflecting the numbers in your books and records, you will want to make sure that if you follow approach A, that you're looking at the required disclosures under ASC 470-10-50. So again, I don't like to read paragraph citations, but that's the approach A. So those disclosures are pretty easy to populate. If you are looking to follow approach B, there really is no authoritative GAAP guidance. So I did provide some pointing direction to a project that the FASB initiated back in 2015. This guidance or this accounting standards update was never finalized. However, there is a fair amount of good recommended disclosure that if you were to use approach B, this may be helpful in making sure that you're providing the transparency to the users of your financial statement. Now, let's shift back to the more traditional discussion points. So we've already talked about, for most of you, the first entry will probably be record your cash, debit your cash, and record a liability. If you did incur cost to get the loan and you consider those costs to be material, if they're immaterial, you would most likely just, hey, we've incurred some expense, we're going to, obviously pay it, and you may just record it under miscellaneous expense or operating expense. But again, if it's not material, that you probably won't get many questions or scrutiny as to where you're going to reflect them. However, if you say, hey, we do want to track these costs incurred, the accounting guidance basically says that any costs you incur in trying to secure the debt, when you record the entry to fund the cash, the debit, which is what you would need to get the journal entry to balance, you would actually reduce the carrying value of the debt. So if you received, let's say, $1 million PPP loan, and you paid, let's say, $10,000 to secure that debt to whomever you would have paid to help get all of your application process in a row, you would debit the debt for $10,000, you would credit cash, so your debt would be on the books for $990,000. If it's a 1% loan over 2 years, which is the standard product under the PPP, you would take that $10,000 and over the 2-year period, assuming no forgiveness, you would amortize that back in. And as you were taking that $10,000 off of your books, the debit would be to interest expense and the credit would be to the debt account to basically bring it back to the $1 million level that would ultimately be paid off under the agreement with your institution that helped you get the loan funded. So again, relatively straightforward, very common to what you would have done with any debt you may have incurred in prior years. And what that really does is just track that as an additional interest expense of obtaining the funding through the PPP loan. The interest expense itself, the way the program was written is that there is a 6-month deferral of interest and principal upon the immediate funding, but it doesn't mean that in that time period that you should not still be reflecting that interest expense. So again, at a 1% rate, over those first 6 months, depending upon how much you receive from the PPP, you would run the calculation and you should be recording interest expense as a debit through your income statement, and the credit would be to accrued interest payable. And then ultimately, when you had to fund the payment of the interest to the bank, you would relieve the payable and fund the actual payment. It is still unclear whether or not the SBA is also going to be forgiving the interest associated with the PPP loan. So until that's confirmed that interest will be a forgivable piece of the proceeds, you would want to make sure that you are reflecting this liability. And ultimately, there will be what I would refer to as true-up accounting on the back end, where if you do find that when you receive notification from your lending institution of the amount that's been forgiven, if you find that it does also include interest, you would reflect the income as we speak about in a second, and you would take the accrued interest payable liability off of your books as well. So the forgiveness of debt, the easiest way to say this is that until you receive formal notification from either your bank or directly from the SBA that the obligation is forgiven, You need to continue to present it in your financial statements and on your records as a loan. You need to continue to accrue the interest on the loan until the ultimate forgiveness amount is determined. So most of you are probably in this process right now where you're in your 8-week period, you're doing the calculation, you're going to make your submission to your institution. They have 60 days to review the submission. We're anticipating that many institutions are very quickly probably going to try and get it into the hands of the SBA, but we're also waiting for guidance from the SBA to see if any burden is being put on the financial institutions to validate the forgiveness applications before they get submitted. So the FIs have 60 days to review. Once it gets to the SBA, they have 90 days to approve. So that's 150 days. That's basically 5 months where you're going to find that this debt will be sitting on your books. So depending upon your year end, you may find that it goes through an audit cycle before you find the actual relief. This next slide is basically the exact language right from the accounting standard codification. But the important part is in item 2, where I've added the emphasis that says you need to keep the obligation on your books until you formally hear that you've been released from it by either judicially or by the creditor. So we anticipate that the financial institution as your creditor would ultimately be the group that would tell you, here's the amount that's being forgiven. Once that amount is forgiven and you know that number, that's your journal entry. You will debit income, and the income, as far as where it's reflected per this slide, is that it just needs to be on a separate line item on your financial statements. We would suggest you create a separate general ledger account to just track this separately and reflect it as forgiveness of PPP loans. So that's going to be an income statement event on your books and records. And any amount that is not forgiven would stay in the debt category. That amount would be the amount you would continue to accrue the interest on at the 1% rate. And that's the amount that would need to be satisfied with your financial institution subsequent to the 2-year expiration term, whether it's a balloon at the end, whether you've created an amortizing loan agreement. And that would also be the amount that, depending upon how significantly your operations have been impacted, the remaining debt's the piece that you would need to talk to your bank about as to how to satisfy that loan, or what would happen at the maturity date if it would be re-underwritten in the form of a more traditional loan between you and your institution. So again, the standards do not dictate where you have to show it on the income statement, but you do just want to make sure that you're documenting very transparently where you reflect it. Our next slide speaks to, again, a very common question, which is, okay, I've gotten the money and I've had all these eligible expenses, payroll, mortgage interest, qualifying utility costs. The big thing to take away from this is just do not net the cost. You are going to treat the forgiveness of the debt as a single line item, probably a single general ledger account on your income statement. All of the other expenses, the qualifying expenses, you should reflect them as you've always reflected them in the past, in their separate expense account line items. So basically showing everything gross. If you were to have $8,000 of eligible expenses and receive $8,000 of loan forgiveness, those two amounts should not net to a zero, because you would lose all comparability for future financial statements or future budgeting or forecasting purposes if you were to kind of normalize them against one another. And lastly, on this slide, as I said at the beginning, the accounting for income taxes on the forgiveness of debt, we do anticipate that that income is not going to be taxed, and that the expenses themselves would not be deductible, because you can't double dip. But again, please talk to your tax professionals to make sure that as you present for financial statement purposes the impact of the PPP program on your operations, that you are properly stating your tax obligations, and if you're a flow-through entity, that you understand how to treat it and passing it through to any partners or anything that would happen in a K-1 or any other applicable tax returns. Lastly, again, the situation is very fluid. We strongly encourage you to monitor the SBA website to make sure that you are looking at any updates to the FAQs, and that you're speaking to your accounting and tax professionals to make sure that if there are any changes to the program or things you should be considering, that you're getting real-time information as you are working through this process. And with that, I believe I am going to turn it over to Bob to take us into the next polling question. So thank you all very much.
Thank you, Barry. All right. Before we start to change gears here a little bit and talk about reopening or ramping up operations, let's look at our polling question number 3. Remember that if you're looking for CPE credits, you need to answer all of the questions. So how much of your workforce do you plan to have back on site or working from your locations by the end of May? And your choices are less than 25%, 25 to 50, 51 to 75, or more than 75%. We'll leave those questions up for a minute or two so that you have a chance to answer. And I want to make sure that I'm keeping us on time today, so I'm just going to roll into our slides. And like I said, I want to change focus a little bit here for the last part of our webinar today and focus on those of us who aren't reopened yet. We may still be in the red or yellow areas, and we've got to develop that plan for getting back up to speed. Or maybe we are open or we're already running, and we want to be concerned about ramping up our operations as quickly and safely as possible. Well, as you've been joining us for the last several weeks on these webinars, you've heard a lot of the physical challenges and guidelines that you're going to have to take care of to do that. You know, social distancing, face coverings, monitoring temperature, employees monitoring symptoms. And I know we shared a tool with you guys last week on how to do that. Cleaning and disinfecting, and they're not the same thing. We'll cover that shortly, and I'll share with you a link to some other information where you can do a little deeper dive into that. You know, and always my fun area, what are we going to do about coffee? Because if I'm not going to get my coffee, then boy, I've got to make plans for that. No, but seriously, this is really about meeting the new safety requirements and making sure that employees, customers, and our vendors feel safe. Because without them feeling safe, we're not going to be able to ramp up or reopen as quickly as we want to. And I want to make sure that we're trying to balance and align our plans for reopening with the need to take care of our employees from a personal perspective, but also realizing that we've got some business responsibilities that we're trying to get back to. We know times are tough, and we want to be able to tackle both and align with those. So as you're developing your plan, I want to just add a couple points beyond the traditional, hey, develop the plan, communicate the plan, implement it, and monitor it. I'm sure most folks have already started to assess their needs, and I want to provide you with a tool and a couple of pointers in the next few minutes on what to look for in assessing those needs and creating those plans. I think one of the key characteristics, if we look at folks who've done this successfully, and I've got a short example for you here, is involving employees and not doing this from the conference room. You know, those employees are the folks that are actually involved in those high traffic areas. They're using your equipment and machinery and office tools. They're the ones that are passing paperwork around. Involving them not only helps balance that need to get them involved and recognize that we're taking care of our workforce, but also gets us to assess these needs quicker than if we were to do it ourselves. Of course, communication is going to be consistent here. I haven't read a lot about training, but there's some interesting reading material out there about even healthcare workers needing consistent reinforcing over the first several weeks of using PPE on how to do that correctly. So as we're doing that training and we're doing this communication, how are we doing that? Are we doing it in a written memo? Are we doing it in pictographs? Are we doing some show and tell with some short videos? And how are we reinforcing that through all this? And of course, as we implement and we continue to support this through more communication and monitoring it, we realize that this, just like everything else, and we've seen that with the PPP and the different government programs out there, things are going to be constantly changing. So it's not just being fluid and flexible to change, to be responsive to changing requirements, but also to changing situations and events that happen at your company. All right, so here's a tool. It's a heat map that you may be able to take and modify for your specific situation. First two lines here are really focused on manufacturing and distribution. We've got office settings here on the third line. And then these last number of lines are really more towards public focused businesses. So, you know, it makes sense to do a walkthrough of your facility, take a hand-drawn sketch, or if you're lucky enough to have a blueprint or a schematic of your facility, go through it and mark up and identify the high-risk areas, you know, with a red highlighter. Look at the orange and yellow highlighters for medium risk areas and identify if there's any low risk areas so that you can prioritize. There's going to be so much to do to reopen and to ramp up that I think you have to divide and conquer and focus on high priority areas. In the short term, it wouldn't be any surprise that we're going to spend a lot of time focusing on the facility, on the social distancing, the physical distancing, and partitions where we can't maintain 6-foot buffers and controlling high congestion, high traffic areas. But hopefully our plan is allowing for us to identify which essential operations need to open up right away and what profitable operations are we going to focus on? I would be surprised that most of us are going to open up at near full capacity right away. So we have a choice as much as we can to identify which operations we want to open first. We're going to be focused on layout like I talked about in common areas and doing band-aids like removing chairs and putting them into storage and taping off areas and putting up signs for travel. Some tools that you may find helpful for doing this besides the heat map, and maybe you do this in conjunction with that plant layout you have or that office layout or schematic, is a spaghetti diagram. And it really is simple as taking different groups of people. If you're in a manufacturing environment, your production employees, follow them around from the time they come onto your facility through the time they leave for the end of the day and where do they travel. And you simply trace that with one color on your blueprint. And you overlap that with other departments. You overlap that with office employees and vendors if they're coming on site. And you overlap that with material flow. And usually the two are coordinated. And as you start to overlap that, it looks like a bowl of spaghetti. It'll be very apparent where your congestion areas are. And you'll probably find a few congestion areas that, if you're sitting back in your office or conference room, that you weren't aware of, especially if you get your employees involved in this process. And then process mapping is really sitting there to identify which parts of our process can we eliminate or streamline. And that'll help us reduce the travel, the handoffs, the interaction between employees, the sharing of tools and things like that. And of course, everyone's going to have the challenge with which employees do we bring back, what schedules do we bring back, how do we do that? It's important to do that. And if we've got customers coming on site, do we schedule customers? Do we have the ability to do that? The same with vendors. If we've got vendor managed inventory, how are we controlling that? Can we shift that to off hours, or can we stagger our employees that are working in those areas to be on break or out of that area while vendors are on site? So again, I think another area is to balance out which employees you're bringing back based on their skill set and what you're needing to have running for essential and profitable operations. In the medium term, we're really going to be focused on a deeper dive into process and workflow engineering to make those changes permanent and expand our scope. Digitizing, we're far from a paperless society that they promised us decades ago. But I think with all kinds of technology that's out there, our ERPs, our accounting and finance systems, our warehouse management systems, our CRMs, how can we take paper out of the process and do things? And we've learned a lot of this in the last 2 months by doing work remotely. And finally, in the medium term, we should be focusing on product and SKU rationalization. There was just an article in the paper today, or was it yesterday, about Oreos only offering 3 or 4 flavors now instead of their standard 10. And, we've all seen that in the supermarket where we're going in and we're seeing less selection of different product. There's plenty of product on the shelves, but it's just not necessarily the SKU variety that we're used to. And then in the long term, is our plan looking at our operating model? Are we looking at our strategy? Are we looking at e-com? Are we looking how we're going to and what are the opportunities to put a remote workforce strategy into place? And again, how are we going to use automation and robotics and equipment and more technology to not only meet the needs and the demands required of this pandemic, but also to strengthen our business and make us more profitable and build us a foundation for growth? For the sake of time, I'm just going to refer you to this article in the Wall Street Journal on May 5th about Germany and how they kept their factories open during the pandemic. This was actually a follow-up to an article they did about 3 or 4 weeks earlier. And I think it's really interesting because of the factories they were talking about, they were running at 70 to 80% of their productivity levels. And you know, there's a lot of things to be learned from that article, but again, for the sake of time, I'm just gonna, you know, I could also offer a link to that article, but it's out there if you just search it. Some of the highlights from there is they did absolutely use employees. And, you know, if everyone's familiar with the German manufacturing and work environment, employees definitely have a seat at the table. And not only did they get the employees involved and around to develop that initial plan, that crisis group meets daily. They don't meet weekly or every other day. They're meeting daily because they're seeing they have to be continuing to evolve and change to the situations that I was talking about earlier. Some companies got creative and 3D printed door handles so you could open the door with a forearm. I just saw that another company is putting foot levers on doors. Hopefully folks have a lot of good balance to be able to do that so they can open doors with their shoes safely. And the big focus here, and think about this as you're working through your processes and your spaghetti diagram, is who shares tools, who shares materials, how do materials flow through your facility, how does paperwork flow, do the spaghetti diagrams, do quick rudimentary process maps to identify those opportunities, and think about how do we disinfect and clean things as much as possible between handoffs. They were really successful in ending shifts 15 minutes early. And I'm sorry, for the sake of time, I'm just going to slip through onto preparing your facility. We're all aware we need PPE available, but have we thought about the disposal? I mentioned earlier that cleaning and disinfecting are different, and there's a link down here to the CDC that explains which chemicals are suggested for which surfaces and which equipment. It's a real good tool for you and your cleaning vendors to put new procedures in place and to train your employees. And the big thing here is we're looking for our facility, especially if you've been shut, is how are your systems? How are your mechanicals, your HVAC, your water systems? It may take some lead time to get your maintenance team or your vendors in these areas, your contractors, on the schedule and take any remediation efforts necessary. So all I'm trying to do is look out for potential snags for you getting back to speed as you can. And there's a link down here on Pennsylvania's guidance on making sure that you're not harboring Legionella or anything else in your systems. And the CDC has a similar requirement out there. Ordering signage, and don't forget, your landlord, your business, your facility owner might have requirements on top of all of this, so make sure you're considering that. And I want to really leave us with this point today, is that I started my comments by saying we've got to balance this need for safety and security with our employees and our customers, with our need to get back to business performance. And if you're not sitting down and deciding what your expectations are for the first week back, for the first 2 weeks back, you know, are you going to phase into things slowly? Or are you going to, you know, if you've got a backlog of orders, if you're lucky enough to have that situation, you know, are you going to go after it with a set of expectations and kind of establish that sense of normalcy again? Again, I think you should take a further look through at least the first quarter so that you can manage how your company is ramping up, so that we're taking a little more proactive instead of reactive approach. We've been forced into a reactive situation the last 2 months. Let's look at measures. Let's look at forward trends like sales and velocity of sales. They can help us make decisions faster. And let's build on the work we've done for the last 2 months. We've all been looking at our cash flow, and we've all been looking at supply chain. Let's find some time to do a deeper cash flow analysis and strategic look into our supply chain to see where else we can find opportunities to improve and stabilize our business. So at this point, I'm going to turn it back over to Ryan. Thank you, everybody.
Great, thank you, Bob, and thank you, Barry, from earlier. I'm going to do our final polling question, and then we'll close things out. Just a reminder is to be eligible for CPE, you need to answer 3 polling questions. If you've done the first 3 successfully, you're good to go here, although I'd still recommend clicking 1 as a backup. If you happen to miss one, certainly feel free to click anywhere here at the bottom is no follow-up needed. If you want to even click that, that's fine. This question just is in regards to any services that we are offering that you would like us to follow up specifically with you about. It's not necessarily a recommendation for future topics on the webinar. It's just for one-on-one follow-up. So please select one of these items if you're looking for credit for CPE. And finally, we will end for the day. Once again, it's been a pleasure to be with you all from the comforts of my guest bedroom. Looking forward to future ones. Please, everyone, stay safe, stay healthy, and if you need us, reach out either through our Coronavirus Resource Center or by contacting your RKL advisor. Thanks, everybody, and have a great weekend.